Hey everyone, George here. So if you're a contractor, a builder, a developer, and you're sitting on an appreciated piece of real estate, equipment, or even stock, and you've been worried about paying tax on the capital gain, there's actually a strategy that you can either defer or eliminate that capital gain entirely. This has been passed with the new OBBBA that came down the pipeline a few months ago. And that's exactly what we're going to be going over today. So let's get started. So how do you get around that capital gain tax that you've been worrying about for so long? So it's actually quite easy. There's 3 steps involved. Number 1, you sell that appreciated asset. It could be real estate, it could be equipment, it could be a piece of land that's appreciated, it could even be stock or equity securities. Normally you'd owe anywhere between 15 to 37% of tax on that capital gain, depending if it's long-term, short-term, between federal, state, and also if there's any depreciation recapture involved. But something just got passed with the OBBBA where you have 180 days to reinvest those funds into a qualified opportunity fund, and that would defer and possibly even eliminate that capital gain entirely. Again, step 1 was to sell the asset. Now step 2 is to invest those proceeds into a qualified opportunity fund. A QOF can be an LLC, partnership, corporation, joint venture. It can take on many different structures, and it basically invests in underdeveloped areas that are designated as qualified opportunity zones. These construction developments could be residential, commercial, mixed use. It could be all sorts of types of construction. It just needs to be in these qualified opportunity zones that are typically low income and underdeveloped areas. So here's the magic that happens. You defer your original gains for up to 5 years. If you hold that position for at least 5 years, you get a 10% permanent reduction in that capital gain. And if you hold that position for 10 years or more, you get a complete step up in basis, meaning you pay no capital gains tax whatsoever. So imagine selling a $5 million project down the road and paying nothing in federal income tax. And if you're in a conforming state or in a no income tax state, you basically keep every penny of that. You pay no tax on that whatsoever. Now, to recap real quick, step 1 was to sell the assets. Step 2 was to invest in a QOF. Now, step 3 is to watch out for QOZ 2.0, which comes out in 2027. So starting on January 1, 2027, QOZ 2.0 kicks in, and this is what's changed. First of all, the program becomes permanent. There's no more sunset dates. Opportunity zones are redesignated every 10 years. But the big thing in all this is that in 2027 and 2028, QOZ 1.0 and QOZ 2.0 actually will overlap for those 2 years. So you have a lot more qualified opportunity zones that could be eligible for this kind of investment. So if you're sitting on appreciated assets or planning a big project soon, 2027 is going to be a big year because you're going to have the maximum number of qualified opportunity zones for those 2 years, 27 and 28. So again, sell the asset, invest in a qualified opportunity zone, and watch out and be aware of 2027 when QOZ 2.0 kicks in, because you have the most possible advantages in that year and 2028. So if you're a rural builder, this gets even better. There are qualified rural opportunity funds, and the benefits with the rural funds is that after 5 years you get a 30% step up in basis instead of the 10%. So that's triple the normal benefit. And the substantial improvement rule is cut in half. So the amount that you need to spend to qualify for what's considered substantial improvement is half the bar of what it is for a regular QOZ. So to go over this real quick, the original substantial rule in a regular QOF is basically you need to improve the cost basis by a factor of 2, not including the land, within 30 months of purchase of the property. So if you were to buy a property for $500,000, so $100,000, let's say, is allocated to the land and $400,000 is allocated to the building, you need to spend at least $400,000 on that property in improvements in order for it to be considered substantial improvement. Now, if this is in a rural zone, Same property, $500,000, $100,000 allocated to the land, $400,000 allocated to the buildings. You only need to spend $200,000 to meet that substantial improvement bar within that 30-month period. That means smaller towns and rural developments could be the most tax efficient way to go, like with respect to these, QOZs. So again, to recap, make full circle, you sell something with a gain, you invest the proceeds within 180 days in a qualified opportunity fund, and you hold that position for 5 years for a step-up in basis to eliminate some of the capital gains, and 10 years to make it completely tax-free. This is for sure one of the biggest wealth building tools contractors and developers have had in the last decade or so since the Tax Cuts and Jobs Act. It's something definitely to think about. If you have a big project, a big appreciated property, and you want to avoid that capital gain, this is the way to go. I hope this has been helpful. Click like, subscribe, turn on notifications for any updates, and I hope to see you in the next one.